Over the past 10 years, ABR has crushed the S&P 500 for total returns. And during that same period, ABR has increased dividends by 233%. If you're looking for income and growth, I think you'll find this episode very interesting. Arbor Realty is a concentrated bet on just one sector, and that is lending money to landlords for multifamily housing. If you're not familiar with the term multifamily housing, I'm talking about apartment complexes for rent. One landlord, one piece of land, and multiple tenants. And whether the economy is strong or weak, there's always demand for apartments because they're just more affordable. In fact, I'd argue that during a recession, demand for apartments actually increases. A quick disclaimer, I'm not a financial advisor, I'm simply an investor that's sharing the research I do for my portfolio. I make these videos to give you some ideas for your own research. The 10-year dividend history for ABR looks fantastic. Most importantly, no cuts during the 2020 pandemic. It's quite common for REITs to keep their dividends reasonably flat, so these constant increases is what got me curious about Arbor Realty Trust. Ticker symbol ABR or Arbor Realty Trust is a real estate investment trust, but they don't own any real estate. Instead, it lends money to investors that own real estate, in this case, multifamily housing. Arbor falls into a subset of REITs called mortgage REITs or mREITs, and they really act more like a bank than a landlord. Over the past year, mREITs generally haven't done very well, but Arbor has actually held up pretty well. So why is that? Well, most mREITs were focused on residential mortgage-backed securities or loans to the office sector or the retail sector, and Arbor avoided all of these areas. 91% of Arbor's loans were in the multifamily sector, so that's a high concentration, and then the rest were in a related sector that we'll get to shortly. I'll admit that finance can get a little bit boring, but I think Arbor's business model is actually quite interesting. Imagine Arbor's business as a three-legged stool, and each leg supports the business in a different way. The first leg is focused on bridge loans for multifamily housing. And they're called bridge loans because they're short-term loans that act as a bridge toward long-term financing. Long-term financing offers the best terms for the landlord, but to get that long-term financing, the landlord needs to optimize the property. And that process might include renovations to increase the rents, and also a marketing campaign to attract tenants and fill the buildings. So during that lease-up period, the landlord will pay a higher interest rate for that 2-year bridge loan while they optimize the property. And if the landlord defaults on the loan, then they have to give the keys to Arbor because these bridge loans are secured by the real estate. And these loans are called balance sheet loans because they're not sold to another entity, they remain on Arbor's balance sheet for the full duration of the loan. The second leg of the stool is called GSE or agency. These are longer term loans, typically 10 years, and they come with less risk and lower interest rates. They're called GSEs because the loans are structured to meet the requirements of government-sponsored entities like Freddie Mac or Fannie Mae. And originally, the US government created these GSEs to incentivize the development of affordable housing. And the value that Arbor brings to these GSE loans is their deep understanding of the GSE requirements, their ability to find the right borrowers, and then lastly, their ability to actually originate the loan. The important distinction for this second leg of the stool is that these loans do not remain on the balance sheet, they're sold to the GSEs. And that brings us to the third leg of the stool, which is mortgage service rights or MSRs. And this is where Arbor gets paid a fee to manage loan payments on behalf of another lender. And that fee is calculated as a percentage of the total loan, it's paid monthly, and those payments go on for the full life of the loan. When interest rates were falling a few years ago, the income stream from these MSRs wasn't really that good because a lot of borrowers were refinancing, and that cut the income stream and of course the loan short. But now we're in a rising interest rate environment, and that's ideal for MSRs. Now, before we move on to my bull case for Arbor Realty Trust, there's one more income stream that's relatively small now, too small to be one of the three legs, but it is growing, so I think it's worth a mention. Arbor has a lending program that's targeted towards developers of single-family rentals or SFRs. And this is actually the fastest growing segment of the housing market, according to the New York Times. These are houses that are built specifically for the rental market to compete against mom and pop landlords. And Arbor acts as a one-stop shop for these developers because they offer construction loans, bridge loans, and permanent financing, so 3 sources of income from just one development. I think it's worth keeping an eye on this business because it seems to be very important to the CEO of Arbor, Ivan Kaufman. If you listen to the Q4 earnings call, when he described this part of the business, he used the word love twice. This is Ivan at 10 minutes and 41 seconds through the earnings call.
We love this business as it generates strong levered returns.
And then at 20 minutes and 5 seconds into the call,
we're really in love with the single-family built-to-rent business. And we're expecting to really dominate that business.
Ivan is a big fan of the single-family rentals. SFR loans have grown to 7% of Arbor's total portfolio, so perhaps one day this will become the fourth leg of the stool. My bull case for Arbor covers 4 reasons why I think this company is attractive. The 3 legs of the stool provide diversified income streams for Arbor, but what impressed me was the synergy between the 3 legs, meaning the way that each of the 3 legs works together to create more value than if you just ran them independently and added up all the revenue. Let me explain. If you look at the second leg, which is GSE agency, this is to some extent a marketing business. Arbor needs to find borrowers that want a 10-year GSE loan. But their advantage is they don't need to go looking for clients. They already have a list of bridge loan clients sitting on their balance sheet that will soon need refinancing into longer term loans. So the marketing process is pretty easy. They just pick up the phone, call their bridge loan clients and say, you're going to be needing long-term financing soon. How about I send you a proposal? It's like shooting fish in a barrel. Then when they sign their existing bridge loan client up for a 10-year loan, they can sell that loan to, say, Fannie Mae and collect a fee. And it gets one better, because they can strike a deal with Fannie Mae to get the mortgage servicing rights for that 10-year loan, more fees. So from just one client, they can make a 2% interest rate spread on a 2-year bridge loan. Then they can refinance that same client into a 10-year GSE loan, take an origination fee, and then they can make a fee on the MSRs for that loan of about 1.3% over 10 years. It reminds me a little of the Carnival Cruise Line's business philosophy from when I worked in the cruise business in the 1990s. If Carnival had a passenger for, say, a 7-day cruise, then they had 7 days, while the passenger is captive on the ship, to generate different forms of revenue, like selling them drinks or spa treatments, tours, or photographs, for example. Then on the 7th day, just as the passenger is about to disembark, on the gangway they grab the passenger, turn them upside down, hold them by the ankles, shake them gently. Why? Just to make sure that if there are any pennies left in their pockets, they get those too. Now that's a joke, of course, but it explains Carnival's philosophy of maximizing revenue from every single customer. I have a feeling the next video won't be sponsored by Carnival. Continuing with the bull case, the second thing that I like about Arbor is their ability to profit from rising interest rates. Even though their cost of funds has increased, their lending rates have increased by slightly more, and the difference between these two numbers is called the net interest spread. In Q4, that net interest spread increased from 2.08% to 2.11%. And to put that into dollars, Arbor's CFO provided the equation. A 50 basis point increase in rates will produce approximately 5 cents a share annually in additional earnings. Bullish item number 3 is also related to rising interest rates. Take a look at this escrow revenue. These are funds collected from borrowers and awaiting dispersion. Previously, those funds were earning almost no interest, but now they're earning 4%, so almost $90 million just fell to the bottom line. Now that's not a huge number for Arbor, but it is free money. And last but not least is the payout ratio. Arbor paid out 70% of its earnings as dividends in 2022. By commercial REIT standards, that's pretty conservative. Obviously, if you pay out close to or at 100%, it doesn't leave much safety cushion for the following quarter. This table from Seeking Alpha gives you some idea of how 70% compares to other commercial mREITs. It's pretty low. By the way, I noticed that Seeking Alpha lowered their first-year subscription down to $99 with a 7-day free trial. I don't know how long that offer will last, but if you'd like to give it a try, I use their premium subscription, then you can use the link in the description. Let's get back to this payout ratio. 70% is pretty low, and that leaves a cushion which they can use to increase dividend payouts in the future, especially if earnings increase. And that's exactly what happened in Q4 of 2022. Arbor posted excellent financial results, the earnings easily beat the estimates, so the scene was set for yet another dividend increase. But Arbor chose not to increase the dividend in Q4. And I think the CEO was surprisingly honest about this. He basically said that in the current environment where competitors were cutting dividends, an increase wouldn't boost the share price. In other words, simply maintaining the dividend would be perceived well by the market. So the net result of higher earnings and no dividend increase was that the payout ratio dropped to 67% for the fourth quarter. Aside from what Ivan said, I think it's also fair to assume that the extra cash in the bank is good preparation for a recession. The bear case for Arbor has to begin with the elephant in the room. The last 10 years have been fantastic for Arbor, but if you zoom out to 2008, well, you could drive a truck through that dividend cut. So what happened? Well, 3 problems. Number 1, they were lending to land speculators and land values collapsed in the 2008 recession. Second problem, they lent to hotels, another sector that was hit hard in the 2008 recession. And third problem was that Arbor back then was taking equity positions in their deals. And when a deal collapses, the equity gets wiped out before the debt. They did survive the recession, but they had to rebuild their business model. So they reduced their hotel deals, their land deals, and their equity participation down to almost zero. I like Arbor's current business model and their focus on multifamily, and I'd have more confidence in them now if they had today's business model back in 2008, because I think then they could have avoided that black eye on their record. The second item for the bear case is Arbor's exposure to the credit markets. Arbor's business model is driven by their bridge loan business, but borrowers won't take out bridge loans unless they're confident that when the time comes, they'll be able to refi into permanent loans at favorable terms. So if, for example, there was a huge spike in construction costs, even more so than we've seen before, or if interest rates went up so high that it wasn't possible to make a profit on a multifamily real estate deal, this would dramatically reduce the demand for multifamily loans. And that's not a risk that's specific to Arbor, it's just the nature of the lending business and applies to all the mREITs in that space. So you basically have to make an assessment of Arbor's ability to weather a storm like that. And this is the reason why the markets get nervous about mREITs during difficult economic times. And when I say nervous, I mean the stock price can get really pummeled. In the 2008 recession and the 2020 pandemic, Arbor's stock price was hit much harder than the indexes, for example. Now, having said that, if you had the stomach to buy Arbor on April 1st, 2020, peak fear for the pandemic, then you'd have a yield on cost of 26%. Not bad. My take is that I do like the multifamily sector. I don't normally like mREITs, but I think that Arbor is best in class, so I made an exception. After a disastrous 2008, they did adapt really well, and for the last 10 years, they've knocked it out of the park. So I bought Arbor last year at $14.90 because I'm comfortable with the risk and I'm enjoying the 10% plus yield. That wraps it up for Arbor Realty Trust. More armchair income coming soon.